Hi, everyone. This is Your Money Matters. I am Angela Durrell, publisher of the Bauman Letter. And joining me today, of course, is Ted Bauman, the editor, and Clint Lee, our research analyst. Now, there's no way to sugarcoat it. This last week or two has just been absolutely brutal. You're looking at the S&P. It's down nearly 5% just in the last week or so. And the Nasdaq is over 8%. So it's kind of ugly. So it's really important during times like this. Ted, you've said it before, stay smart and stay tough. Now, for those of you watching, the absolute best way for you to stay smart and tough is to actually join the Bauman Letter. If you're interested in more details, there's a link above and below. So please be sure to check out all of those details, see how Ted could help you get through these tough times. Now, Ted, I'm actually going to turn to you because this has all happened before, of course. So I'm sure you've learned a lesson or two and some good nuggets that you could share with our viewers.
Oh, yeah. In fact, I was just saying to Clint that, now that I've been running an investment newsletter for a couple of years, this is not my first rodeo, when it comes to big corrections. And the reason I wanted to talk about this today is because it's just how it made me feel, on the one hand, those same feelings came up that came up in the past. Like, oh my God, what am I going to do? My readers are going to hate me. I'm going to get emails saying, why did you buy this stock? Look at what is happening. But then I realized that last time that happened, the stocks bounced back and everybody forgot about, how upset they were. And those people who bought more of them when they went down ended up doing really well and told me, hey, thanks for recommending that pick. It was a good one. So the key thing is you mentioned how, you get this smart and tough stuff from our newsletter. Well, part of that is just having access to people who have been around the block a few times, people like Clint, people like me, you, Angela, you're also a trader in your own account and all that. So everybody knows, what it's like to go through these things. And the problem is that sometimes you just need a little bit of reinsurance that you're not alone. So today, what I wanted to do is show two of my experiences, horrific experiences, and what I've learned from them. The first one is a chart that shows what I call my mad money account. It's essentially just an account that holds, I use it to trade like the SPACs and the IPOs and things that look like they're going to be, interesting and exciting, and they might make me a lot of money in the short term, all that kind of stuff. It's not my main.
To be clear, this is your personal trading.
This is one of my personal accounts, but these are not positions here.
Right.
But anyway, so I managed to grow that account by about 600% last year. Very, very high risk. I was playing all the really risky stuff, but it was ratcheting upwards. Like every time I'd take profits on a position, I'd plow it back into another one. Anyway, it's fallen by, let's see, over 35. It's getting, probably today it's down by 40%. So that's like almost half the money that I made that's just evaporated. So, this is happening to me. That's what I'm saying. And it makes me feel really bad. But what I haven't done is sold any of the positions in that account, because I know without a doubt that the last time this happened, they bounced back. And when I sold, it was a dumb thing to do. So I've learned that lesson, but it's not just coming from my personal accounts. Here's a position that we bought in the Bauman Letter back at the beginning of 2019. It was an IPO called Jumia Technologies. It's an African e-commerce company. It still has great potential. It's been doing really well. But when we bought it, just like the day after or something, there was a big short seller attack on it. Andrew left, who is now sworn off short selling attacks. Funny enough, I felt really good when I heard about that. But anyway, so it just took a nosedive and it went down and down and down. And eventually it got to the point where I just realized, look, I can't in good conscience recommend holding this stock. But I was wrong. I was very wrong. I mean, look what happened to that stock. We sold it in about, I guess, around December, maybe 2019. I can't remember exactly when, but we basically sold it near a bottom because I lost faith in it. And look what happened. It rebounded. And I get emails now from people telling me, hey, I know you sold it, but wow, I've made like 400% on the stock.
Great.
So, I'm just laying my mistakes out there and saying what I've learned from them is do not lose your faith. There's nothing fundamentally wrong with any of the picks, for example, we have in the Bauman Letter with Profit Switch, and of course, Clint, has an option trading service that can play both directions, which is great.
Right.
But the key thing is that you subscribe to something like our newsletter because you have access to people who have been through this and whose job it is to figure out what it takes to be smart and tough. And that always comes down to knowledge about why something is happening and what is likely to happen next. And that's where I think Clint can maybe give us some good advice.
Yeah, Clint, you've been around the block too, so give us some good advice.
Yeah, I was telling Ted earlier about this episode. It's a different movie, but a very similar plot. The angle that I'll look at it from is kind of from how the quant crowd or algorithmic traders can be impacting, what's going on in the market. There's two types of strategies I think of that can be very disruptive to the markets. And one is very much in play right now as the culprit behind, I think, what we've seen these last couple of weeks. And the other's really been absent. I want to start with the one that's been absent first. And that's sort of the volatility crowd. These are traders or strategies that tend to increase or decrease their stock market exposure based on what volatility is doing. And these are the ones that can really create sort of this broad market meltdown, this cascading effect, like a waterfall decline is what it almost feels like, because they will sell everything. They don't look at certain sectors or certain stocks. I mean, when they want to rebalance their portfolios and get out, they get out. Risk parity is one of these types of strategies. And that's where, instead of having the sort of your traditional 60-40 portfolio where you're 60% stocks, 40% bonds, they'll dial up or down the stock exposure based on how risky stocks are. But I want to give an example of why, I don't see this crowd being very active in the sell-off right now. I've got a chart to highlight this point. So this is goes back a couple weeks to the peak in the market. Green line showing the S&P 500 index, the blue line showing the VIX index. And when we had the initial downturn in the market and the spike up in the VIX, that's what I'm showing with the circle on here. But then you look at what happened after that. The S&P made a new low, but the VIX did not make a new high. The VIX stayed below sort of that 2930 level. And so what that tells me is that it's not a broad market sell-off that we're seeing. And in fact, you point out the S&P 500 is down about 5% or so. But then the Dow is only down about 3.5%, but the Nasdaq's now down over 11%. So it's in correction territory. So what that tells me is that this is very much a sector rotation that's going on underneath the hood. It's not everything selling off, but certain sectors are being impacted. And so that's where another type of strategy that kind of comes into play with the algorithmic crowd, and that's momentum strategies. And a lot of times what happens here is they'll create long short portfolios, and it's simple based on momentum. It's buying the stuff that's been doing well and going up and shorting the stuff that's been going down. And as a perfect example of that, and that's what's going on right now. That's what's been happening the last couple of weeks and what you've been seeing. And here's a great example of it. This shows year to date an energy sector ETF, XLE, against the ARK Innovation ETF. And this holds a lot of the high flying tech growth stocks that have been very popular here lately. But you can see what's unfolded here, especially over the last couple of weeks, where you've had energy just continuing to surge higher against this massive sell-off that we've seen in the ARK Innovation ETF. And just as more evidence that you're seeing sort of the algorithmic crowd pressing their shorts against ARK. Here's a chart that shows, once again, going back several months, but the bars on here is a short interest in the ARK ETF. So you can see the continuing increase in short interest just shows is the evidence that these, whether it's algorithms or other traders are continuing to short the ARK ETF. So it shows you that what's going on underneath the hood is more of just a massive rotation out of growth and tech names and into more cyclical areas of the stock market. And that is dragging the whole stock market down to an extent because it tech's 25% of the S&P 500. But as I was highlighting earlier, there's a lot of dispersion in those returns. The S&P down 5 to down 3 versus the Nasdaq down 11. And so you haven't seen really broad-based selling meltdown type stuff at this point yet.
So just to point out that that's precisely what we'd been predicting. I think going even back to last year, we'd been saying that this is what was going to happen. Because logically, if the economy starts doing better, the real economy, then you start looking at opportunities in companies that have been relatively undervalued, companies that are going to see their earnings increase because the economy is recovering, and that the companies that had been overvalued really because they were the only game in town. I mean, and we know all the reasons. We know that there were people who had money, they had time, there was a lot of hype going on, and we saw all these trends that were pushing this particular class of stocks, like the archetype stocks, higher. So there's nothing illogical or unexpected about this at all. The only thing you never know is exactly when it's going to happen. So, for example, we've bought some stocks that probably fall into the ARK category in some of our portfolios that have taken a beating. Now, you can look back and say, well, why did you buy them if you thought this was coming? Well, you never know, right? You never know when it's going to happen. But what you do know is that although those stocks might revert to a long-term mean, that trend is still going up. That long-term trend is still up. You talk about renewables, you talk about electric vehicles. I mean, those things are not going away. So if you've lost 20 or 30% on one of those stocks, yeah, it sucks. And it's going to take you a while to get back up to where you were. But the way to improve your gains is to buy more of them, not to sell them. That's the mistake I made with those charts I showed earlier. So, again, this is just one of those things that happens in the stock market, folks. And we've seen it again and again and again. And all you got to do is just remember that, things are going to get better. And when they get better, you'll be a lot happier if you don't sell everything right now. That would be a big mistake.
Right. It's worth noting that since 1920, the S&P has experienced a pullback of 5%, 3 times a year. So you're right. This is absolutely nothing new. It's scary, but it's not new. And in the end, we know how this is going to end up. And if you're hanging on to good stocks, you're going to come out ahead eventually. So thank you so much, Ted, especially for sharing that, because hopefully there's some good lessons in there for people watching. I know it's not easy to admit when we make mistakes, but it's important so we can learn from them. Thank you everyone so much for watching, and stay smart and stay tough.